Dave Ramsey is a guy who loves to take the safe, easy, and reliable route when dealing with anything that has to do with finance. So when he was asked about upcoming hyperinflation, he had quite a shocking and unexpected answer.
My question, Dave, is as a fiscal conservative, I'm a little bit concerned. With the money supply increasing by $3 trillion in 1 year, the printing press is churning, and the Federal Reserve is manipulating markets by even buying junk bonds. We've got double-digit unemployment, and we have a president who is calling for negative rates and who, politics aside, is objectively a fan of debt and bankruptcy. So with that said, my question to you, sir, is where do you see inflation going if they continue to this printing? And what do you say to people like Ray Dalio who say gold should occupy a place in the portfolio as a hedge against inflation? That's my question.
Well, you've been listening to me for a while, so you know I'm not going to tell you to buy gold.
Yes, sir.
And that you knew that before you called, and I don't know Ray, and I don't know what his teachings are, but I don't buy gold, and I don't recommend people buy gold. And we can talk through why. Let's pretend for a second that hyperinflation occurred. Okay, that your worst fears with your scenario occur. Okay, and we go back to the Carter administration, and we had 10 and 12% inflation a year, which we haven't really seen since then. But let's say that happens due to the oversupply of money and these $3 trillion bailouts, and that's what you're worried about. And I agree with you that what they've been doing up there is unwise, for sure. I don't think it's going to take us to the same place you think it's going to take us to, but let's just pretend it did, that it takes us to a real heavy inflation rate. There is no promise that gold follows that.
What Dave is saying here goes against what billionaire investors like Ray Dalio and Peter Shiff preach nearly every single day. Gold's price is heavily correlated with inflation. He claims that past results are no guarantee of future outcomes, and while that is of course true, it's also a philosophical trap. Every single financial decision you make is based on past outcomes predicting future results. For an example, Dave loves to promote mutual funds as a way for people to generate wealth. But who's to say that mutual funds continue their trajectory up? Well, they have in the last 40 years. There's no scientific reason that they endlessly continue this path other than the fact that history has proved that the S&P 500 on average goes up around 7% a year. The same prediction can be made with gold and inflation. This scientific study published in December of 2017 examined the relationship between gold prices and inflation, looking at a 40-year period in 3 different countries. What researchers found was that gold does indeed offer protection against an increase in money supply throughout the entire past 40-year period in the US and the UK, with one exception, Japan. Now take a listen to this next portion.
There is no promise that gold follows that on an inverse relationship, meaning there is no promise that the value of gold goes up as the value of the dollar goes down, because they are not tied together in any way. There is no index. We do not operate on the gold standard anymore. And so gold goes up like all commodities: oil, gold, silver, agricultural products like wheat. These are all, they go up based on a perceived shortage or they go down based on a perceived oversupply. When there is a shortage of gold is when people are greedy and they think that they're going to make a bunch of money on gold, so they rush gold or anything else. And when there is or when they're afraid. And so like during coronavirus, gold went up.
Dave here is claiming that the emotional attachment to gold, especially during times of crisis, is the only reason for its value, and that it's simply not a safe asset. In fact, he outlines how the US dollar is the same way, a green piece of paper that has no intrinsic value. These deep philosophical reasons surrounding this idea that money is more spiritual than mathematical may actually be true. We know that most financial assets are based upon trust. Gold, if you want to look at it from an outside perspective, is indeed just a shiny yellow rock. But it's a shiny rock that people have trusted for value for over 5,000 years. Even civilizations that had no perspective on the outside found this rock to be special. Take for an example the Aztecs, which didn't make contact with the Europeans until the 1400s, yet still regarded gold as the product of the gods. So while yes, gold is indeed just a weird rock, its history dates back to the earliest humans. Simply dismissing thousands of years of results is plain wrong in my opinion. So why would he tell people to stay away, even as the United States looks to be entering a period of high inflation that could wipe out savings accounts? Dave's last argument is this.
It's not safe. It is a golden colored rock. It has no intrinsic value except the fact that two different people are fighting over it. And that's the only thing that gives it value. The same exact thing that gives a green piece of paper with the president's face on it value. It has no intrinsic value. It's a green piece of paper. The only reason it has value is that people want it from one another and will accept it from one another. That's the only thing that gives it value. And so my friend Rabbi Lapin talks about money is spiritual in that sense, in that it is based on trust. It is not based on mathematics. And the trust that I can train a green piece of paper or a bar of gold or a golden cufflink or something for something else, then that's what makes it valuable. And so in the event that that an economy collapses, we do not automatically rush out with bars of gold to the quick sack and fill up our car.
The problem with this argument is really simple. Gold isn't for bartering during a collapse. It's for transferring wealth into a new currency after a collapse. Here I'll give you a quick example of a currency and an economy going through a serious meltdown as we speak. Lebanon. The country's currency, the Lebanese pound or lira, has been taking a nosedive in terms of value. As of February, the monthly inflation rate is over 136%, and that's the official statistic. Many in the country claim that it's much worse than that. Now ask some of these Lebanese citizens who, for an example, had £1 million in savings last year. What happened to their accounts? But before I show you, please make sure you hit that subscribe button if you're enjoying.
Now the dollar reigns supreme, spiraling in value amid unprecedented instability.
We'll be watching TV and there's some political news that things are getting better. And people rush here to sell dollars as if they were millionaires. And sometimes there's just one bit of bad news on the TV and they're buying dollars, not selling anymore.
After a succession of crises, authorities restricted dollar withdrawal rules and tried to impose official exchange rates. But nothing has stopped people turning to the parallel market.
You see, common sense gold bugs don't necessarily claim that gold is the currency of the future, but rather that gold has been, is, and will be the standard for preservation of wealth even when your local currency faces a crisis or failure. The only thing that stands up to fight that theory is cryptocurrency, which right now is challenging gold as this magical material or code in the case of Bitcoin. All of these assets have one thing in common. They are essentially useless by themselves. The only reason they are valuable is because the collective mind of society makes it so. The thing about economics is that it's not a science, and the presumed notion that humans only act rationally is deeply flawed. Otherwise, we wouldn't place so much value on a useless piece of rock or a currency that, backed by nothing physical, can buy you the world. Thank you guys for watching, and please make sure you hit that subscribe button if you enjoyed.